This is Angel Insights brought to you by SyndicateRoom. This is the podcast that dives inside the world of early stage tech investing to reveal the tips, tactics and strategies of some of the best investors in the industry. And joining me today, I'm delighted to welcome Paul Arnold. Paul is the founder of Switch Ventures, a seed-stage venture fund where he takes a very data-driven approach to founders and how they can be evaluated, which we'll deep dive more on in the show. And prior to Switch, Paul was a senior executive at AppDirect, where he helped build it from a small startup into the gigantic unicorn that it is today with its $1 billion plus valuation. And he saw all the incredible takeaways that come with watching a company like AppDirect scale into hyper-growth mode. And before AppDirect, Paul was with the one and only McKinsey Company in Silicon Valley. However, enough from me, so I'm delighted to welcome Paul Arnold at Switch Ventures. Paul, a huge welcome to the show. It's such a pleasure to have you on. Thank you so much for joining me today.
Glad to be here.
Now, I want to start off today by hearing a quick 2 to 3 minute snapshot of how you made your way into the world of early stage tech investing.
Yeah, no, happy to talk about it. So I came out here to Silicon Valley knowing that I wanted to be involved in startups. I had a strong interest in startups and venture and what was going on. I had the chance when I was back in New York in the early 2000s to work for a startup and kind of caught the bug there. And so I came out here, out of school, joined McKinsey in the Silicon Valley office as a way to kind of cut my business chops for a little while. Spend some time around sort of the tech ecosystem, with the plan of moving over to a startup at some point. And so I was there for several years and had the chance to join a small startup called AppDirect, which was about a 20-person company or so, fresh off a Series A round with plans to scale up. And I joined as sort of the first business executive hire to that team, and had the great fortune of it being just an awesome company. So in the time I was there, we went through extremely rapid scaling. I got to lead several of the teams. I led business operations and kind of operations generally across the whole company, and specifically led about 4 other teams as we scaled up to a quite meaningful company. One of the unicorns, I guess now. And so that was exciting time to go through that hyper growth, to see the challenges of everything from a kind of a 20-person company to a several 100-person company, and the many different phases you go through as an executive and a manager and a leader to take a company through those cycles. And while I was there, I was making angel investments. I was very interested in what was going on in venture, and I was kind of just writing little checks out of my bank account and realizing that I had a very serious interest in taking that more seriously. I launched sort of a proof of concepts fund on my own, and that was about 2.5 years ago, and started making investments, started dialing in my approach to startups, started, kind of building my track record and seeing how deals get done, and building my own sort of sensibilities about how I wanted to go about this, which, in short, it ended up being a very sort of data-driven, predictive analytics type of approach to founders, investing in the seed stage. And today I've made 25 investments across about 15 companies. As a whole, they're doing pretty well. So it's been a really enjoyable journey.
So I have so much to unpack there, but let's start with your time in operations. And I want to hear, you said about this hyper-growth scaling that you achieved when in operations. So what were the big lessons that you took from watching the company you were with scale into hyper-growth mode?
Yeah, it's interesting. There are all these kind of phases on the kind of maturity that a company goes through, and you can all sorts of organizational scholars at business schools write about these things, but it's so abstracted that when you're at a startup, you go through these phases incredibly rapidly. You don't spend sort of many years in kind of startup phase and many years in kind of growth. You sort of have to reinvent yourself constantly. So for us as we were growing. I think we went from 20 to 120 within like a year and a half. The org charts got reinvented like 5 times. People's roles shifted so often. Sometimes narrow or sometimes broader. Sometimes moving to new teams. We took very broad roles that we broke down to very specialized roles. And so with all that, there's a whole lot of kind of process. A whole lot of, thinking about how do you get things done? How do you split teams up? How do you organize people to work effectively? How do you get formal? Which, a small startup is not very formal because everybody's kind of sitting around a table. But as soon as you've got a couple hundred people, you have to have a lot of kind of rules and systems and processes in place to make sure that you're still getting things done well. And, it's just this aggressive and rapid kind of process of reinvention. And it's kind of running fast on that treadmill to keep up with it and kind of see where the long-term plan is of what you want to be running like when you really are big.
And do you find that churn in employees concerning them when you're an investor in them? When you see them scaling into hypergrowth and there is a large amount of churn internally, be it in roles, leaving, or just internally switching, does that concern you?
It depends. So, you said two things, and one of them, which is that people are changing roles a lot, that doesn't concern me at all. If it's kind of a nimble team, and you have leadership that is not kind of spinning their wheels, but purposefully kind of iterating on their organizational structure, that's great. That's awesome. And if you have employees who can move around into different roles over time as the organizational needs change or you're growing so fast, that's great. Well, we didn't have this at AppDirect, but many companies do, which is the churn of people leaving. That definitely is concerning. And some of that is good and some of that's natural. And some of that you want, but you won't want to see very much. It's kind of a red flag of something going on.
Have you ever seen any founder disagreements with any of your investments in terms of actually founders breaking up?
I haven't had any founders breaking up. And in general, the founders in my portfolio get along fairly well. To the degree there have been kind of mild tensions, they've been resolved. It's certainly as an investor something you worry about quite a lot. I've thought about it a lot making investments, whether the team dynamics are kind of genuine and lasting. And when companies are going to I'm investing in seed. When I see companies going to their Series A and B, it's often a big topic on the diligence calls with the follow-on investors. Really getting to understand, what drives the founders to be able to work together. So I've been fortunate not to have a nasty one, but it's certainly a worst case scenario.
And how much do you agree with the founder market fit analysis that we often hear today, with the founder kind of being highly aligned to the market that they're operating in? Because often I speak to VCs turned operators who've simply kind of found a market opportunity in VC and then solved it as a founder, not really implying founder market fit. So how do you approach founder market fit?
I do tend to think that founder market fit is, most of my companies have founder market fit. And I when I see it, it's a positive thing. If I see somebody coming in totally from the side, I have to really understand why they're coming into a totally new industry. But most of my companies, and largely it's just because you do what you know. So Policy Genius is a company where the founders came out of the insurance practice of McKinsey and have been doing a lot of work for insurance and saw problems in that industry. Mode's a company that it was a data science team at Yammer that spun out, and they thought the data science team should work differently, and they had all this firsthand experience. Danielle at Mattermark kind of came out of a journalistic background where she was digging into all this research on startups to write her stories and realized that there wasn't a good database out there. So I tend to see a lot of founder market fit, and it's almost just natural. But when you don't see it, and you do have to wonder if the person actually understands what they're getting into.
Would you invest if you didn't potentially see it? So if I was founding a elderly care home software and it made no relevance to me, but I was a brilliant technologist, would that concern you?
I don't want to make hard and fast rules, but it certainly raises the bar.
Yeah.
It's something I have to get into then to understand it.
Yeah, absolutely. And you said about the tester fund there that you started with, and I'm intrigued to hear about the strategy that you employed from that start in terms of kind of check size. Was it a rigid check size to start with? And what type of cadence did you go for investing?
Yeah, it was, the check sizes were small because it was sort of a, proof of concepts fund, just sort of building the record. So I was writing sort of $50,000 type checks. That wasn't super rigid, but that was kind of, the numbers swung around there. So not terribly large checks, but I was trying to get in the right deals that I would want to get into writing larger checks later. The cadence was about 10 investments a year over that time, and that included initial investments, mostly at the seed stage and some at the pro rata stage. The story, I guess, of kind of the journey through that proof of concepts fund was, I largely started out doing what I knew best in terms of industry. So I was investing in things that were really kind of close to home and that I understood well, enterprise SaaS or data or some of these markets I had a real kind of intuitive personal grasp on. Over time, that really evolved into a kind of a people-first strategy, which was really highly informed by a lot of data analytics work. So, we spent about 6 months building out a database for the fund, working with the data science team, with some of my friends at Mode and the team in India and some other folks here as well. And making a lot of kind of predictive analysis about what type of founders do well and what type of founders we think will do well in the future. And perhaps it's just my way of thinking. Probability was kind of my favorite class in college, and I always am trying to get my hands around these numbers, to try to make all these intuitive feelings and senses and conventional wisdoms concrete.
What conventional wisdoms did you come to on the founder analysis?
There's a lot. So there's certain groups I bet on big. So McKinsey alumni are one that I tell people often I bet on really large because they dramatically outperform. But there's part of that's talent, part of it's all these different reasons. But part of it's also that like the landscape's shifted. You'll have a conventional wisdom that all these large companies are built by engineers. And if you talk to old guard VCs, folks who came up, especially in the 90s or something, that they'll tell you that that's the way to bet. Well, it's not so true anymore. A lot of these biggest and best companies are being built by business leaders or sort of consumer, insight marketing driven folks. Certain types of companies that the tech side of the equation has actually become a lot easier. So if you're building an e-commerce site and you have tremendous insight about, kind of a subscription model of e-commerce or something like that, there's a real marketing driven insight that's building your business more than tech. And so I think that, a conventional wisdom that was clearly upset was what type of people are actually found in these types of companies. Not to overstate it, engineers are still hugely important if you're building a database company or something, but it's that type of stuff that I was sort of really sussing out.
Absolutely. No, that makes perfect sense. And I think McKinsey's hiring strategy is kind of so high that it does lead to massively increased probability. But you said about the check size there being about 50K. I'm intrigued at that size. How much of a role does valuation play when it comes down to the investment decision-making process for you?
Yeah, and those check sizes have increased meaningfully since kind of I first started. But valuation matters, and it matters more in 2016 than it might have, for everybody in the market than it might have sort of a year and a half ago. It matters. Everybody says you don't want to miss Facebook because of valuation, and certainly there were investors that did make that mistake. But for most companies, you have to have kind of a bit of sensibility about it. And you have to realize that if you're consistently overpaying, you're going to consistently underperform on the back end. And so it's certainly part of the conversation. I certainly have conversations with founders where I'm really excited about their idea, but the valuation feels like a no-go. We have that conversation. And often we're able to kind of come into something that works for both of us. I think it's kind of foolish to not be paying attention.
Yeah, no, absolutely. And kind of talking about, you said there the check size variance, and you did do 50 and now you do much more. Fantastic. But I'm intrigued to talk about that division then between angel and VC where you are today, and discuss the mindset shift that occurs between the two and how that changes for you.
Yeah, the biggest change is almost administrative of kind of, dealing with all the dynamics of actually having a fund, the legal aspects and the accounting aspects, the regulatory compliance. There's sort of a big chunk of that type of stuff that gets added to your plate that as an angel you have the freedom to not think about, but it's just sort of a necessary part of having a fund. So that's a big part. There's there's a heavy responsibility that comes with having other people's money, I think as well, which is sort of informs your mindset. You want to be a very good steward of it, and I think that's always in mind.
And then I want to talk. You said about 25 investments into 15 companies, so it suggests 10 follow-on investments. And I had a guest on the show the other day who said all early stage investors have to follow on. They have an obligation to follow on. Do you agree with that? And what's your strategy towards follow-on funding?
I wouldn't say I agree with that. And my strategy is not to always follow on. Conversely, a lot of people say their strategy is to never follow on, which is another kind of end of the continuum, I suppose. For me, I don't worry too much about signaling risk. I think it gets overstated a little bit. I've not been in a deal where, let's say there's, a lead's going to come in on a later round for, let's say, $8 million and it's a $9 or $10 million round. That deal doesn't sort of rise or fall based on who follows on. That deal kind of that conviction is already sort of held by the follow-on investor when you're at that point in the conversation. But, for me, it's about sticking with companies that I feel like I can continue to add value to, that there's a good relationship, good sort of situation of working together and helping them build the company. And so I do selectively follow on.
And I'd love to dive into a quick fire round with you now. So I say a short statement and then you give me your immediate thoughts. How does that sound?
Yeah, sounds great.
So what's your favorite investing resource? This could be a kind of blog, it could be a newsletter, or it could be a book.
Oh, great question. So for me, I think it would be my database and all my sort of data and analytics that I keep back pocket. For me, that's just fundamental to how I think about my investments.
Mm-hmm. What's the biggest challenge to you today investing?
It's staying on top of all the many things to do and saying no to a lot of great people. As trite as that sounds, it's not a part of the job I love. But unfortunately, you say no to a lot of great people who are probably, many of them will actually build great businesses, but you just have to say no a lot.
What's your favorite aspect of the role?
Working with entrepreneurs that are, they have big visions, and they really do want to change the world. And, VC is this just amazing job where you get to be involved with so many of them, and so many kind of parts of the future that are coming together. It's cool.
Does increasing lengths of privatization for companies concern you as an early stage investor?
It doesn't concern me that much. As long as companies can continue to grow in the private markets, I'm patient. And if they can better grow in the private markets than they can in the public markets, then I'm okay with it.
And then what aspect of yourself would you most like to improve upon as an investor? And then what do you think is your strongest?
I think my strongest aspect is just sort of my ability to relate to people and then sort of having a down-to-earth approach, connecting with different folks. And what I'd like to most improve upon is probably finding more hours in the day. Is that fair?
Yeah. Do you have any productivity hacks and tips for us that will help us find more hours in the day?
Send me some of yours. My best one is hiring folks in India that help out on sort of repetitive tasks.
Oh, really? What type of tasks?
So I maintain a lot of sort of databases and sort of tracking lists, CRM types of things around founders and startups. And I kind of have my own view, which is different than what I have in any sort of tool that's out there. So I have a lot of people tracking automated tasks like that.
Would you say venture's a science, not an art?
No, I think the best venture is both.
Okay, absolutely. And then I want to finish today on your latest investment, your public investment, that is, and why you said yes.
So my latest investment is in SkyFit, which is a mobile app for fitness. It's a bit like SoulCycle meets your earbuds. With you pay a subscription, you sort of choose your workout program, and you have a coach that's coaching you through all your workouts. And it's highly motivating. There's intense loyalty among the early consumers. The company is off to a great start and has a great sort of product vision and a very, very loyal fan base. I love using the product, and I think they got a strong team that's going to take it.
Paul, it's been absolutely awesome to have you on the show today. Thank you so much for joining me. I really do appreciate it.
Thank you, Harry.
What a fantastic show with Paul, and so brilliant to hear his data-driven approach to evaluating founders. And if you'd like to see more from SyndicateRoom, then you can head over to www.syndicateroom.com and head over to the Learning Academy, where you can find a whole host more early-stage investing resources, including podcasts and articles and guides. There's a whole array, so do check that out. Or you can follow us on SyndicateRoom at SyndicateRoom on Twitter. As always, we so appreciate your support and look very forward to bringing you next week's episode.